On November 12, 2025, Bitcoin clung to $101,800, an 18% drop from its peak, with over 95% of its promised 21 million coins already in circulation. BlackRock calls this the ultimate digital gold rush. But if that is true, why do the world's sharpest investors warn that, at these levels, your fortune could vanish overnight? The answer starts with math, and what nobody else will tell you comes next. Bitcoin's price, as of November the 12th, 2025, stands at $101,800. The number itself carries weight, a round figure, a headline, a psychological anchor. Traders watch the order books flicker, each tick up or down feeding a sense of either relief or dread. Just 5 weeks earlier, Bitcoin touched an all-time high of $126,223. The current level represents an 18% slide, a reminder that even at the top, gravity has not been repealed. On trading desks from Singapore to New York, the mood is tense, but not yet panicked. Some see a buying opportunity. Others see warning signs multiplying. Volatility, once a badge of honor in the crypto world, now feels like a threat. The market's collective pulse is visible in the spread between bids and asks, in the sudden rush to stablecoins, in the sharp drop in open interest on major futures platforms. Overnight, billions in paper wealth can vanish or reappear, depending on which way the wind blows. The price chart is more than a line. It's a mirror for hope and fear. At $100,000, Bitcoin's market cap hovers near $2 trillion, putting it among the world's most valuable assets. But history is littered with peaks that looked unassailable until they weren't. The Nasdaq once soared above 5,000 before giving up nearly 80%. Gold hit $850 in 1980, then spent decades in the wilderness. Each time, the numbers felt permanent until they faded. Right now, the market acts as both judge and stage. Every new headline, every ETF inflow, every regulatory rumor is reflected in the price, sometimes within minutes. The sense of inevitability that once drove buyers now gives way to calculation and caution. At this level, the stakes are no longer theoretical. The market itself becomes a character, restless, unpredictable, and utterly indifferent to anyone's dreams of easy riches. With each passing hour, the question grows sharper. Is this a pause before another leg higher, or the edge of the cliff? The answer, as always, will be written in the numbers. Bitcoin's code enforces a hard ceiling: 21 million coins and not a single Satoshi more. This is not a marketing slogan or an ETF sales pitch. This is math, written into the protocol and guarded by every node in the network. By November 2025, the world has already mined about 19.95 million Bitcoins. That's more than 95% of the total supply, as tracked by public ledgers and confirmed by independent data from Y-charts. What remains is a trickle, roughly 1 million coins left to be created, spread out over the next century, with each new block yielding less than the last. Scarcity here is not theoretical. Unlike fiat currencies, where central banks can expand the supply at will, Bitcoin's issuance is fixed by consensus rules that have never been breached. Every 10 minutes, a new block is added, and the reward halves every 4 years. The most recent halving in 2024 cut the block subsidy again, slowing the pace of new coins. The effect is cumulative. The pool of unmined Bitcoin shrinks relentlessly, while the number of people and institutions seeking a share keeps growing. This arithmetic underpins the entire valuation debate. At $100,000 per coin, the market is pricing in a future where scarcity itself is the main feature. BlackRock's IBITETF literature, for example, puts the 21 million cap front and center, promising investors exposure to something that can never be printed or diluted. The circulating supply, just under 20 million coins, now forms the basis for a market capitalization approaching $2 trillion, a figure that rivals the GDP of most countries. But the numbers are inescapable. With more than 95% of all Bitcoins already mined, the remaining supply is not enough to satisfy new demand at scale. ETF sponsors, corporate treasuries, and retail buyers are all competing for the same shrinking pool. Every purchase by one investor is a coin that cannot be bought by another. The protocol's discipline leaves no room for negotiation. 21 million forever. The rest of the story, valuation, adoption, and risk, unfolds from this unyielding arithmetic. Imagine the number, $1 million for a single Bitcoin. At the protocol's hard cap, that would mean a total market value of $21 trillion. For context, that figure is larger than the entire United States economy. America's GDP hovers around $27 trillion, depending on the year. It is also on par with, or even above, the total value of all the gold ever mined, which analysts peg somewhere between $20 and $29 trillion in 2025. This is the scale of ambition being floated by the most optimistic Bitcoin advocates, not just a new asset class, but a contender for the world's dominant store of value. The mental leap required is enormous. Gold has been hoarded, traded, and worshipped for thousands of years. Its market is broad, deep, and liquid, with central banks, sovereign funds, and private vaults scattered across every continent. Bitcoin, by contrast, is 21st century code, a digital ledger with a fixed supply, no cash flows, and a settlement network that processes a handful of transactions per second. At $100,000 per coin, Bitcoin's total value stands at about $2 trillion, or less than a tenth the size of gold. Pushing that number to $1 million would require an influx of capital so vast it would eclipse every previous wave of adoption, and likely demand that governments, pension funds, and entire industries convert reserves en masse. This is not just a question of price. At a $21 trillion market cap, Bitcoin would have to clear not only the gold benchmark, but also the scrutiny of policymakers and the practical limits of its own infrastructure. The numbers are seductive, but the path from 2 trillion to 21 is paved with assumptions about utility, about trust, about global consensus. The gold comparison sets the bar, but also exposes the gulf between narrative and reality. When investors picture a $1 million Bitcoin, they are not just betting on scarcity or code. They are wagering that the world will rewrite its entire definition of value. Spot Bitcoin. ETFs have changed how capital flows into the market, but their structure introduces new pressure points that few retail investors fully grasp. At the core, these funds operate through a creation and redemption mechanism. Authorized participants, usually large financial institutions, deliver Bitcoin to the ETF sponsor in exchange for new shares or return shares to receive Bitcoin back. Each transaction happens in sizable blocks, often well above $25,000, far out of reach for most individuals. The underlying coins do not scatter across thousands of wallets. Instead, custody is highly concentrated. In the United States, Coinbase custody dominates as the primary vault for these assets, holding the bulk of ETF reserves in cold storage. By late 2025, spot Bitcoin ETFs in the United States collectively controlled between 5% and 7% of all circulating Bitcoin, as confirmed by industry trackers like The Block and BitBo. This means that a single custodian, Coinbase, is responsible for safeguarding a sum worth well over $50 billion, an amount that rivals the reserves of some national banks. On-chain dashboards allow anyone to verify these holdings, but transparency does not eliminate risk. If Coinbase custody were to face a technical failure, legal freeze, or targeted attack, the consequences could ripple across the entire ETF ecosystem. Regulatory rules require asset segregation and periodic audits, but the reality is that most of the ETF supply sits in a handful of wallets, all managed by a single provider. Insurance policies exist, but they rarely cover the full scope of potential losses in a true crisis. The process also gives authorized participants and market makers significant influence. They can arbitrage price differences between the ETF and spot markets, hedging their exposure with futures or other derivatives. In times of stress, when redemptions surge or liquidity dries up, these actors may be forced to unwind positions rapidly, putting additional strain on both the ETF and the underlying Bitcoin market. Every link in this chain, ETF sponsor, custodian, authorized participant, represents a potential point of failure. As ETF adoption grows, so does the concentration of risk. The plumbing that enables mainstream access to Bitcoin may also be its weakest link. On September 7, 2021, El Salvador rewrote the rules by making Bitcoin legal tender. The law, passed by a clear majority in the Legislative Assembly, forced every business to accept Bitcoin alongside the US dollar. Overnight, a digital asset born in internet forms became the official currency for an entire nation. The move drew global headlines and sharp warnings from the IMF, but for Bitcoin advocates, it was proof that adoption could leap from private wallets to national treasuries. El Salvador's president, Nayib Bukele, doubled down, announcing government Bitcoin purchases on social media, launching a state-run wallet, and even floating billion-dollar volcano bonds backed by future mining revenue. The experiment turned a small Central American country into a test case for sovereign-level crypto adoption, watched closely by policymakers and traders alike. While El Salvador made headlines, Wall Street was quietly building its own exposure. By June 30, 2024, Goldman Sachs disclosed positions worth roughly $419 million across 7 U.S. spot Bitcoin ETFs. The figure, buried in a routine SEC13F filing, reflected a deliberate scaled entry rather than a speculative punt. Goldman was not alone. BlackRock's IBIT, Fidelity's FBTC, and other ETFs reported surging assets under management throughout 2025, with institutional flows accounting for an increasing share of new demand. In October, U.S. crypto ETFs recorded a single-week inflow of $5 billion as Bitcoin touched new highs. These are not retail traders chasing meme coins. They are asset managers, pension funds, and bank trading desks allocating capital in units measured by the ton. Public filings and on-chain dashboards confirm that ETFs now hold a sizable slice of all circulating Bitcoin, between 5 and 7% by late 2025. Each new inflow is a signal, not just to markets, but to regulators and corporate boards. The demand narrative is no longer confined to online forums or retail exchanges. It now runs through bank balance sheets, sovereign reserves, and the formal machinery of global finance. Bitcoin's legitimacy, once dismissed by central bankers and Wall Street veterans, is now written into laws, filings, and institutional portfolios. The euphoria that follows is not just retail-driven. It is institutional, sovereign, and at least for now, still gaining speed. The week ending October 4th, 2025 set a new standard for capital rushing into crypto markets. CoinShares tracked $5.95 billion in inflows to crypto ETFs worldwide, with $5 billion landing in US-listed funds alone. Bitcoin's price responded in real time, climbing to an all-time high of $126,223 on October 5, 2025. The magnitude of these flows was unprecedented, even for a market accustomed to sudden surges. ETF dashboards lit up with record net creations, and the largest funds scrambled to source coins from an already tight supply. Each new inflow meant more Bitcoin locked away in institutional cold storage, further reducing what was available on exchanges. The order books thinned as buyers overwhelmed sellers. Market makers widened spreads, sensing that liquidity was growing scarcer by the hour. On-chain trackers showed a spike in large block transfers as authorized participants moved coins to meet ETF creation demand. For a brief window, it seemed as if the market's appetite was insatiable. Every dip was met with fresh capital, every rally fueled by yet another headline of record-breaking flows. But beneath the surface, the mechanics were growing fragile. With so much capital crowding into a finite asset, small imbalances could trigger sharp moves. The ETF structure, designed to provide easy access, now concentrated risk in a handful of custodians and intermediaries. As more coins were removed from circulation, the remaining float became increasingly sensitive to order flow. A single large redemption or a sudden reversal in sentiment could force market makers to unwind positions in a thin market, amplifying volatility. The euphoria of early October was palpable, but it came with a cost. The record inflows that drove Bitcoin to its peak also strained the market's ability to absorb new demand. Every new high was achieved with less and less liquidity, raising the odds that any shock, regulatory, technical, or psychological, could tip the balance. The capital that powered the ascent had also set the stage for instability, leaving the market perched on a narrowing ledge. A handful of players now sit atop enormous stacks of Bitcoin, holding keys that could unlock sudden waves of supply. MicroStrategy stands at the front of this line. By mid-2025, the company's filings showed a treasury swollen to nearly 600,000 Bitcoin, about 3% of all coins in existence. Michael Saylor, the company's chairman, has made no secret of his philosophy. He describes the position as a binary bet, with outcomes he frames as either 0 or a million. To fund these purchases, MicroStrategy issued billions in convertible debt, doubling down even as prices soared above $100,000. The company's balance sheet is now fused with Bitcoin's fate. If the price rises, the equity balloons. If it falls, the leverage cuts both ways. But MicroStrategy is not the only entity in this position. Government agencies, most notably the U.S. Department of Justice, manage their own caches of seized Bitcoin, accumulated from criminal investigations and forfeitures over the past decade. While headlines sometimes exaggerate these holdings, the reality is more measured. Since 2013, the U.S. government has seized well over 360,000 Bitcoin in total, but the vast majority has already been auctioned. Current estimates put the remaining federal stash in the tens of thousands, still enough to move markets if released in size, but not the six-figure cliff often cited in crypto lore. Each new seizure or auction is a market event, watched by traders for signs of sudden, outsized selling. These concentrations create a structural fragility. When so much supply is locked in a few hands, whether corporate treasuries, exchange-traded funds, or government control, the risk is not just that one will sell, but that the market cannot absorb it if they do. A single large holder, forced or tempted to liquidate, could trigger a cascade of selling that overwhelms the thin liquidity typical at the extremes. For MicroStrategy, the calculus is existential. A margin call or debt maturity could force asset sales at precisely the wrong moment. For government agencies, policy or legal action could put thousands of coins on the auction block with little warning. The system's apparent stability rests on the continued willingness and ability of these giants to hold. Should that change, the resulting supply shock would not be gradual. It would be a cliff, and the market would have to find a new equilibrium on the way down. On October 10, 2025, the liquidation engines roared to life. Bitcoin's price, already wobbling, plunged from $122,000 to $104,000 in a matter of hours. Over $19 billion in leveraged positions were wiped out across the major exchanges. More than 1.6 million traders saw their margin evaporate. Their positions forcibly closed at whatever price the market would take. The order books, once thick with bids, went thin as paper. Market depth collapsed by more than 80%, leaving a handful of buyers to absorb an avalanche of forced sales. The machinery behind this event is both automatic and merciless. On platforms like Binance and Bybit, traders routinely take on 20 times, 50 times, or even 100 times leverage. When prices move even a few percent against them, liquidation algorithms step in, selling collateral into a falling market. Each forced sale drives the price lower, tripping the next round of liquidations. This is not a slow bleed. It is a chain reaction, with each domino knocking over the next. By the time the wave passed, insurance funds set aside by exchanges to cover bad debts were depleted or dangerously close. Bybit's insurance pool ran dry, forcing the platform to claw back losses from traders who had managed to stay solvent. Binance's internal risk dashboard flagged a near breach, as the fund lost 60% of its reserves in a single evening. Market makers, who normally provide stability by buying and selling at tight spreads, pulled their quotes or went offline entirely. Liquidity vanished, leaving only the liquidation bots to fill the void. On-chain data from CoinWatch and YQ confirmed the scale. Entire blocks of sell orders, tens of thousands of Bitcoin at a time, dumped into a market with almost no resistance. Exploiters targeted flaws in collateral pricing, triggering localized cascades that accelerated the spiral. Stablecoins, meant to offer shelter, faced $9.4 billion in redemptions in 2 hours, with some losing their dollar peg on smaller venues. Exchange risk officers, not regulators, made the call to halt trading. For a brief window, the market was effectively frozen. Withdrawals stalled, prices gapped, and the illusion of liquidity shattered. The aftermath left millions nursing losses and the system exposed. The liquidation spiral was not just a technicality. It was the mechanism that turned a sharp correction into a free fall, revealing just how quickly confidence and capital can disappear when the only buyers left are the algorithms programmed to sell. Trading halted in an instant. As the liquidation cascade ripped through the order books, major exchanges triggered their own emergency protocols. Circuit breakers snapped on at Binance, Bybit, and Gemini, freezing activity as prices spiraled. Withdrawal requests piled up by the tens of thousands, but the screens showed only error messages and spinning icons. For millions of users, balances became numbers on a page, untouchable, unmovable, and suddenly meaningless. Exchange announcements arrived in rapid succession. Binance cited unprecedented market volatility and paused all crypto withdrawals for several hours. Bybit followed, invoking risk management protocols and suspending both fiat and crypto outflows. Gemini and several smaller platforms issued similar statements, each blaming network congestion, but the real culprit was thin liquidity and the threat of insolvency if redemptions continued unchecked. Inside chat rooms and social feeds, panic set in. Traders who had watched their positions liquidated now found themselves unable to move what little remained. Over-the-counter desks reported a surge of desperate calls from funds and family offices, all seeking a path out before the next freeze. Stablecoin issuers, facing a torrent of redemption requests, imposed their own withdrawal gates, further bottlenecking the system. Tether and Circle handled nearly $10 billion in redemptions within hours, pushing some venues to the brink of depegging. On-chain data confirmed the gridlock. Mempools swelled as users scrambled to push transactions through, but confirmation times stretched from minutes to hours. Even those with priority fees found themselves stuck in a digital traffic jam. Some exchanges, fearing a run on reserves, quietly disabled internal wallet transfers, trapping coins within their own infrastructure. For the first time in years, the promise of 24/7 liquidity collapsed under its own weight. The freeze exposed a hard truth. Access to assets is never guaranteed when everyone runs for the exit at once. Circuit breakers, designed to calm markets, became barriers to escape. Withdrawal halts, meant to protect platforms, left traders locked out of their own accounts. In a system built on the idea of self-custody and instant settlement, the reality was a sudden, jarring lockout, one that would have consequences long after the price stabilized. On Bitcoin's base layer, the numbers are inescapable. The network processes between 3 and 7 transactions per second. Visa's system, by comparison, routinely clears over 20,000 transactions per second, with capacity tested above 65,000 at peak. This gap is not a theoretical footnote. It shapes the daily reality for anyone trying to use Bitcoin as a payment rail at scale. When demand surges, during price spikes, panic sell-offs, or even routine ETF inflows, the mempool swells, fees climb, and confirmation times stretch from minutes to hours. The protocol's design, with 10-minute blocks and a fixed block size, sets a ceiling that no amount of market enthusiasm can lift. The 2024 halving delivered another blow to the system's underlying economics. With the block reward cut in half, miners saw their main source of revenue slashed overnight. By the second and third quarters of 2025, public miner filings showed EBIT margins squeezed below 15%. For many, the margin was even thinner, single digits for those with older hardware or higher energy costs. Some miners exited altogether, forced to sell reserves or shut down operations when revenue no longer covered expenses. The hash rate may have reached new highs, but the security budget now depends on a shrinking pool of operators who can survive on razor-thin profits. The combination of low throughput and stressed miner economics exposes a fundamental tension. Bitcoin's protocol guarantees scarcity, but not scalability or sustainable returns for those who secure the network. As the price climbs and mainstream adoption grows, the infrastructure beneath the surface is pushed to its limits. The technical bottleneck is not a distant risk. It is a daily constraint, shaping every transaction and every decision made by miners, exchanges, and users alike. Speculation always feels new, but the script rarely changes. In early 2000, the Nasdaq Composite stood above 5,000. Tech stocks with no profits traded like lottery tickets. By late 2002, the index had lost nearly 80% of its value, wiping out trillions in paper wealth. Cisco, Amazon, and hundreds more saw their share prices gutted. Pets.com and eToys vanished altogether, their logos outlasting their balance sheets. For many investors, recovery took more than a decade, if it came at all. Gold tells a similar story. In January 1980, gold spiked to $850 an ounce, fueled by inflation fears and global uncertainty. The price collapsed almost as quickly as it had risen. Within 2 years, gold was down 65%. It would take 28 years for the metal to reach that nominal peak again, and even then, inflation-adjusted losses lingered for a generation. Scarcity did not spare gold holders from decades of disappointment. Bitcoin's own history is no different. After peaking near $20,000 in December 2017, it fell 84%. The 2021 cycle followed the same pattern, a 77% drawdown from its high. Each time, the narrative was that this time was different, that the fundamentals had changed, but the numbers were relentless. The cycle of euphoria, collapse, and slow recovery repeated itself, leaving behind a trail of retail traders who bought the top and held through years of regret. These episodes are not ancient history. They are the recurring pattern of markets gripped by hope and then broken by reality. The lessons are written in the charts and in the lives changed by each reversal. Prices can fall further and stay low longer than most are willing to imagine. A tech worker in San Jose opened a Binance account in early 2025, convinced that leverage was the shortcut to financial freedom. He watched influencers on YouTube walk through 100 times leveraged futures trades, each click promising outsized returns. By October 2025, he had rolled small wins into a six-figure position, long at $105,000. When the crash hit, the liquidation engine closed him out in seconds. His entire account, over $90,000, was gone. The platform's insurance fund offered nothing. The next morning, he was left with a transaction receipt and a zeroed-out balance. Across the Atlantic, a TikTok creator in Berlin borrowed against her apartment to buy Bitcoin at $122,000, convinced that digital gold would secure her future. The bank approved the loan, and the money landed in her exchange wallet the same day. 2 weeks later, after the liquidation spiral, she filed for bankruptcy. The court documents list a $150,000 loss with no assets left to recover. Her story now circulates in crypto forums as a warning. When the margin call comes, there are no second chances. In Singapore, a university student pooled family savings into a Huobi account using a marriage license to bypass regional KYC limits. He went all in on leveraged longs, posting screenshots to group chats as his balance soared. When the market reversed, the losses piled up faster than he could react. Overnight, he owed more than $150,000, money he did not have. His crowdfunding plea, written in 3 languages, is a snapshot of despair repeated thousands of times. None of these traders owned productive assets. There were no dividends, no rent checks, no underlying business, just the hope that someone else would pay more. The lesson is old but often ignored. The margin of safety is not a meme. If you cannot sleep with the risk of an 80% drawdown, you are not investing. You are gambling, and the house always wins. Today, nearly 600,000 Bitcoin sit on a single corporate balance sheet, while spot ETFs absorb a growing share of the world's remaining supply. As past bubbles remind us, concentration and narrative alone do not guarantee safety. At $100,000, the risk is not just volatility. It is believing the crowd will always have your back. In markets, conviction is easy, liquidity is fleeting. When trust turns, only one exits first.